are in listen-only mode.
Good afternoon. We thank you for taking the time to attend this webinar today. The topic for today's webinar is Creating Value Through Differentiated Customer Interventions by CLTV. Our presenters today are Shupriyo Sen and Giri Iyer of Optimal Strategics Group. Shupriyo is the Executive Vice President and Global Head of Financial Services Practice at OSG. Shupriyo has over 20 years experience across analytics, strategy, innovation, market research, and product line leadership. Prior to joining OSG, Shupriyo had leadership roles in AIG, focused on life, health, retirement, and asset management. Our second speaker is Giri Iyer, and he is Executive Vice President, General Manager, and Head of Analytics Technology Practice at OSG. Giri has over 25 years experience in advanced analytics, healthcare, energy, and retail. Prior to joining OSG, Giri had leadership roles in GE Healthcare, Compaq, Philips, and Siemens in P&L management, corporate strategy, and business development. Without further ado, let me present to you Shupriyo Sen and Giri Iyer. Gentlemen.
Thank you, Geeta. And hi, Giri, how are you?
I'm good, Shupriyo.
Excellent. So I thank everyone participating on the call today for attending. This is part 2 of a webinar series that we kicked off earlier in March. Just to provide some context, this series is a 4-part series, and our focus is to outline and provide an overview of how we assisted a global insurance company maximize their product portfolio by taking a look at customers and, most importantly, understanding customer lifetime value. In the last call, in the last webinar, we talked about behavioral analytics. More importantly, what is behavior and how it drives customer choice. And then from there, we described in good detail how to segment customers leveraging behavioral analytics and traditional methods of predictive analytics as well. Today, we're going to focus on 3 key things: risk, how to understand customer risk, customer lifetime value and how to measure it, and most importantly, how to understand and leverage both an understanding of risk and lifetime value to launch the right customer interventions at the right time. So that is the topic of our discussion today. And just to give you a lay of the land, first we're going to talk about measurement of risk, how to develop an integrated measure of customer risk, how to measure customer lifetime value, and then most importantly, how to deliver the right customer interventions to maximize profitability. And finally, we'll open it up for questions.
So Shupriyo, a question for you. What are the measures you believe goes into creating a holistic customer risk integrated measure?
Excellent. That's a very, very good question, Giri. So this really helps us set the stage for the rest of our discussion. An integrated measure of customer score goes across multiple dimensions. We're going to take the context of life and health insurance, but the same spans for multiple other industries in financial services as well. But if you focus on life and health, most companies look at understanding their customers by their risk profile, their clinical risk profile. They understand their financial behavior and risk that comes along with it. Companies also go to the extent of understanding risk as it pertains to a particular customer by way of their propensity for lapse. There are also some elements that companies bake in for understanding lifestyle risk. And I think this is a critical element of the discussion. When Giri, you asked, what is an integrated measure at OSG? What we do is we integrate the measures and the risk across lifetime, clinical, financial behavior, and lapse to come up with a holistic measure of how customers, what customers look like and the kind of risk they possess for any life and or health insurer. So why is lifestyle risk important? The rest of the risks that we talked about, which are clinical oriented, which are lapse oriented, which are financial behavior oriented, they're traditional measures, and there are very well established techniques for getting to those calculations. What we want to focus on during our discussion, in addition to those other dimensions, is lifestyle risk, and put deep emphasis on this, because lifestyle and understanding and accurately being able to measure lifestyle risk is a key differentiator for understanding customer risk in totality, measurement of customer lifetime value, and then most importantly, being able to launch the right interventions. So if you look here on this page, what we've highlighted are some important metrics that go to show that lifestyle risk is a key measure that companies ought to focus on. 70% of all diseases and subsequent deaths in the United States are lifestyle-based. If you look at our health insurance spending, and this is a important topic of discussion during our, in our current political environment here today, the United States has a very high sort of customer spend for healthcare, and 86% of our national healthcare costs are because of lifestyle-related diseases and deaths. What is most important to note here is that when companies are able to combine an understanding of traditional health risk elements along with lifestyle-based health risk elements, the predictability of overall risk improves by nearly 45% or more. So it's a significantly important measure.
Shubhra, this is fascinating. So can you give us a little bit more detail regarding what are the top diseases associated with lifestyle-based and the choices that customers make?
Absolutely, absolutely. So this is a study that came out of the CDC and a whole host of other medical institutions where there are a significant number of diseases that are out there, and many of them very, very common, ailing our population. If you look at the list on the top left, diabetes, hypertension, cardio, and these are the things that everyone is very familiar with. Stroke, many cancers, mental health issues like Alzheimer's, even osteoporosis and arthritis. Many of these diseases are strongly correlated to lifestyle. So if you look at cancer, you will see that, and this is a study that was put out by the American Cancer Society, that diet, smoking, sexual behavior, occupation, alcohol consumption, your exposure to sun and radiation are directly correlated to the emergence of cancer in individuals. If you look at heart attacks and cardio, there's a strong correlation there as well.
It's really interesting you mentioned that, Shubhra. How strong do you think is the correlation between lifestyle and some of these diseases? Because as you might imagine, many of us have heard so many things about family history or genetic predisposition and what have you.
There is definitely a strong correlation. Great question, Giri. There's a strong correlation. It depends on disease by disease on a case-by-case basis. If you look at heart attacks, cardio issues, a very interesting study came out in the early 2000s which showed that heart attacks due to family history only accounts for about 1% of the risk, whereas 90% of the risk is primarily due to lifestyle. So this is one example that I wanted to put out here, Giri, and it goes disease by disease, but in a nutshell, there is a very, very strong correlation between various lifestyle factors and the emergence of any of these diseases or the combinations of these diseases within individuals. So if you look at lifestyle and want to understand the various factors that impact an individual's risk for disease and or emergence of combinations of diseases, it is a non-trivial issue. At OSG, we have developed a proprietary scoring algorithm that goes across various attributes. Some of them are demographic, some of them are direct clinical oriented, but we put a strong emphasis on understanding lifestyle and behavioral risk, and then come up with a composite score for determining the individual health risk, which is lifestyle-based for members and customers of life and health insurance companies. The dimensions that we look at for lifestyle and behavior-based attributes are fairly extensive. We found that there is a strong correlation between physical activity, the level of physical activity that any individual may take, partake during any given day and week, nutrition, their general health and behaviors based on smoking and drinking, and obviously other factors like safety. What are the measures that they take in their life based on their lifestyle to take measures to prevent accidents and other injuries? And then there are a whole bunch of other dimensions also, which is basically your mental wellness, your mental well-being and wellness. Do you have a stressful life? Or do you take measures to reduce stress in your life through meditation and or other relaxation techniques? What kind of a job do you have, and what kind of stress does that job create? What is your personal family situation like, and is there emotional stress and understanding of emotional factors that lead to a whole host of other things? So the combination of all these factors really then is taken into account and holistically integrated to come up with this lifestyle-oriented risk score that OSG develops. And I want to hand this off to Giri, because a chief architect within OSG for calculating the score and then recommending how companies ought to use this is Giri Iyer. So Giri, do you want to talk briefly about this particular slide?
Sure, Supriyo. So, and I think it's really important to remember that all these behavioral attributes, in the end, if you are a global insurance company, you will fundamentally ask the question, so what do you want me to do differently? What interventions do you want me to take? And how many of my members do you want me to touch and nudge, if you will, to change or shape or mold a different behavior? So what we did here fundamentally was, without going into the details of the algorithm, basically say that for a lot of the members exhibiting good behavior, let us say with a score over 75, we don't perceive any immediate risk. It's going to be okay to leave them be and continue the way they are. But for those between, say, 55 and 75, those are the ones where we start monitoring their health and the choices they are making a little bit more closely. But certainly, in order to ensure member wellness and their family's wellness and naturally aid in the value add that we can provide to these members, as well as focus on the portfolio profitability, it is important to have scores like what we did for this customer here, and we recommended a score of 55 or below to identify and flag those individuals who specifically should be intervened with, should be nudged, whether it's an email or whether it is an SMS or a combination thereof, or even a phone call, if you will, but to make sure that they understand that there is a need for them to go through a health checkup. And then you can design the right incentives to make sure you can maximize the likelihood of engagement with those customers. Shukriya?
Great, thank you, Giri. One other comment, one other sort of fact that I wanted to point out is for life companies, and Giri gave an excellent example for how health insurers are leveraging this and may be able to leverage a score like this and an understanding of lifestyle-based clinical risk. A lot of life companies today are on the pathway to simplifying their underwriting process and developing products that are guaranteed issue. So the objective there is to eliminate the need for labs and other intrusive forms of testing that often intimidate and prevent customers to follow through. So through OSG's methodology and being able to understand and accurately predict various lifestyle factors that correlate very heavily to clinical risk, life insurance companies are also able to then leverage this algorithm to simplify their underwriting process and even develop and issue guaranteed issue products. So with that said, we've talked about lifestyle, but lifestyle is not the only thing that we consider. What we also do is, in addition to the lifestyle orientation of individuals, we also take a look at hard facts, and this is clinical in nature. So we've partnered with a leading medical institution based out of the United States, but they're global. We've partnered with Johns Hopkins University, and we leveraged their highly validated, extensively tested global algorithm for measuring morbidity and even mortality for members and understanding based on various factors, demographic factors, medication usage, the combinations of various diseases, what the risk of an individual is, and what that correlates into a claims risk. So in addition to lifestyle orientation and lifestyle-based behavioral risk score, we also combine a clinical risk score to understand the customer. So going back to your question earlier that you posed, Giri, about how do we calculate a holistic risk score for our customers? Today, given the nature of our webinar and the limited time that we have covered really and talked extensively about lifestyle orientation and the risks that we calculate from there, a clinical risk score that we're able to calculate. We're also able to leverage and understand credit scores of individual customers and figure out and create a score for their mortality and or morbidity risk based off of that. And then we also look at individual customers in portfolios to understand their lapse risk. The goal here is to truly combine all of these dimensions and come up with a composite risk, which basically customers, clients, insurance companies can then basically use to figure out what is the overall risk of this particular customer, and most importantly, how valuable they may be for the insurance company over the long run. And I think that basically brings me to a very good segue here, because we've talked about calculating risk scores, but why do all of that, right? And as I just alluded, the intention here then is to take a deep understanding of risk on multiple levels, and then truly to figure out what is the value of a customer to a firm, to an insurance company, not just as a snapshot in time, which is transactional in nature, but over a time horizon. So with that, Giri, I'm going to hand it over to you to talk a little more about customer lifetime value and why it's important.
Sure. And for those of us who get intimidated by a sophisticated looking mathematical formula, guys, it's not that complicated. The principles are very, very simple around customer lifetime value, but it is a very powerful algorithm. So let me break this down for you really quick. The formula that you see here, which brings it all together into one simple algorithm, one simple metric to measure the vitality and the value of a portfolio. It really combines three main aspects. First and foremost, as any global insurance company would know, there are significant acquisition costs associated with bringing members, bringing customers and individuals and families on board, but whether for life insurance or health insurance or other supplemental insurance. So that's the acquisition cost. The second thing to recognize is, yes, there is a premium stream associated with an inflow, and then there is a claim stream that goes out that is based on whatever claims are filed against the insurance policy. So that there is obviously a differential between that needs to be carefully managed. And the other dimension that it becomes really important to understand here is there is a propensity, and hopefully it's a small propensity, but there is a propensity of customers to not renew their policy, or to use the industry term lapse. What we are looking for is to specifically find a way to understand, recognize, and manage that retention rate. That is the third dimension of it. And fourth and finally, there is a time horizon with an associated cost of capital that is unique to every single organization that we work with. No two organizations are the same. Putting it all together then therefore gives you the CLTV or the CLV or the lifetime commercial value for the customer. And as you can look at that, it basically aggregates that across, if you will, a 10-year horizon, across the numerous number of policies that are brand new and acquired during the year, as well as those policies that don't lapse, that are renewed during a year. So it's a pretty exciting and simple way for an organization to unite behind one algorithm that gives them a measure of their portfolio's viability.
Excellent, Giri. So proof's in the pudding, right? And the so what question is so important, right? This is a great measure. We've talked about measures so far, various different measures for risk. We're bringing it all together into a integrated customer lifetime value. What is the so what behind this? Why is this relevant, and how can firms leverage this sort of measurement to drive value creation for their enterprise?
Such a great question, Shupriya. So let me answer it the following way. First and foremost, as most insurance companies know, there is a drive towards making sure that you understand how to deliver the right intervention for the right customer at the right time. But even before that, the idea behind the analytical framework is to say, how do we optimize our resources across the various touch points that we have for our customers so that we are able to balance our need to acquire more and more customers, i.e. grow our portfolio. And there is multiple ingestion points that our software system takes that data point from, whether it is coming from online and digital, or those who have agencies and are representatives selling the products of our global insurance company, or intermediaries like banks or the call center folks who are proactively calling and trying to make sure they can offer timely renewal services to their customer. The answer is we integrate all of that into the system, tie that to the underwriting system, tie that to the proposal writing system, and pull in the holistic score that Shupriyo had talked about, which pulls in across labs, across financial indices, as appropriate clinical and other behavioral scores, along with the CLTV calculation that I just went to, and pull that into three types of analytics fundamentally, which is, do we understand our customer and how they behave today? Do we understand our members, our portfolio, and how it is behaving today? Let's call that descriptive. The second one, which is really powerful, which is really where the CLTV plays a huge role, is to basically say, can we therefore predict the vitality of our portfolio on a base set of assumptions, knowing that a certain percentage of our resources are dedicated to acquiring new customers, and a certain portion of our resources are dedicated to holding on to and managing better our existing customers. And there is where, if you will, these interventions become so important, and let's call that category prescriptive analytics, where we fundamentally say, what are we now going to do individualized for each one member at a time, one policy at a time, to make sure they are better customers, we serve them better, and we are offering proactively better service to them so they are happy to continue to be part of the global insurance company's member family. So that's, if you will, the analytical framework that we put together. Integration point that I highlighted are to those back-end systems, and some of them are updating on a regular daily basis, and some of them are updating on a more, if you will, batch process to make sure that we are able, as a big data platform, to pull all these various data points and algorithms together. If you can turn to the next page, what it really does is very powerful for us. So let me kind of walk you through what this page is showing you. I'll point your attention to the left of this page and look at your y-axis here. It is basically the lifetime commercial value going from low to high on the y-axis, and lapse, which is the propensity of a customer to lapse, a member to lapse, being on the x-axis going from low to high. What that does is create a very simple 2x2 matrix for you, and I'm using my mouse here for those who are following along, and I'll just give you an example of one of these quadrants. So let's call this the northeast quadrant, where it's high CLTV and high lapse. And as an insurance company, what we're specifically looking for is, gosh, these are high CLTV customers who are actually profitable for us. What can we do to make sure that we reduce their tendency to lapse from us? And what we did for this particular customer that we worked with is, we, based on all the behavioral and clinical and other attributes that we were able to do, we were able to create a persona, a unique profile that contains all the underlying attributes that were very, very actionable for our customer. Let's call this sub-cohort the young and restless segment. With them, the goal then therefore is, what are we going to do to drive superior engagement so that we reduce their lapse risk? I'll give you one other example very, very quickly to make sure this 2x2 matrix comes alive for you in terms of the intervention thought and strategies. Let's look at those where their children are now growing up, and they're beginning to leave their houses to form families of their own and go live with their friends or their loved ones. These are a growing category of customers who, in this particular case, are also people who are looking for more services, if you will, from a health insurance perspective. And what we found for this segment was they really belong to the lower CLTV, but also the good news being lower lapse. They are long-term members or aspirationally long-term members of this global health insurance company. What we need to do here, and we call this sub-cohort the empty nesters, is to basically help them manage their disease progression. I think Supriyo touched on beautifully the lifestyle-based diseases. So how do we help them make better choices, right choices every day, every week, every month, and we offer the disease management services so that their spend, if you will, their claims are more balanced, and then they're also becoming more profitable for us as an organization.
Excellent. Excellent, Giri. So if I can just make a quick comment, thank you so much, because what this framework shows you very quickly is, and this is something that we touched on during our last webinar, is that segmentation is important. So once, and companies often embark on a segmentation journey, and once you understand the segments, then truly the question then becomes, within each segment, who should you go after, and how should you provide differentiated services or differentiated interventions to them. So the framework that Giri so eloquently outlined here is to really look at the value that they bring, not just today, but over a time horizon. And you really want to go after those customers that are high value and really nurture those relationships. So the bottom dimension then is lapse, right? So when you bring these three elements together, segmentation, the value of the customer over time, and are they going to stay with you or not? So then really you begin to understand who you should go after and what you may be able to do, to keep them with you. So on the note of retention, Giri, can you give us an example of how, operationally speaking, I mean, when this is all good, this is great advice, this is great analytics and insights, operationally speaking, how might a company bring it all together to make sure that their best customers are retained and then the right programs are being offered to them?
No, that's such a great question, Shupriyos. If you will, what we did working with the customer was make sure that we created a basket of very targeted use cases. And on the next page, there is just one of the many examples that I will give to you. But basically, the idea is for each of these cohorts, whether it is a young and restless cohort or the young family cohort or the empty nester cohort, there has to be a basket of, let me call them tactics, that we have to try out and make sure we test the effectiveness of the program in terms of A, improving this lifetime commercial value, and B, reducing their lapse, and C, making sure they have a good experience. So just one example here on this page, and let's call this retention management. So the profile of the customer here, just very, very quickly, is they are high CLV, they are low claims risk, and the lapse risk is medium. So they tend to belong to, if you will, the northeast quadrant of the previous page. They are typically, a good customer for us to have. So what do we need to do? Well, first and foremost, we want to make sure they are high priority. So the action plan that we worked with the customer was very simple. This is the customer that you need to have a high intensity follow-up. Call them, email them, text them, SMS them, but make sure you're reaching out to them and they're feeling your love. Number one, very, very important. This is a priority. Number two, what are you doing from a strategy perspective to them? Very, very simple, but yet very powerful. Make sure they know that there is an opportunity for you to do more and for them to do more with you. Whether it is buying another product which offers ancillary value to you, which is the whole idea of cross-selling, or upselling them and basically saying, hey, did you know we can do something else for you and bring in potentially more members of your family, or bring a whole other product available to you here for and increase the price of the product that we're selling to them in an attempt to make sure they appreciate the value that we are providing. So what we have done here is fundamentally launched a cross-sell, upsell campaign for this very high profile and important priority segment, right? I'll give you one other very quick example just to give you a sense for how you have to iterate and fight for the attention and the engagement of this customer segment. Now, what happens if this customer segment, now I'm at the bottom of the page, in addition to being high lapse risk and medium CLV, also has high claims? Well, they still are high priority for us. The intensity of follow-up is still high. But at this point of time, our interest has to shift, and the strategy has to shift to recognize that they have a propensity for high claims. So what do we need to do? So what we did with this global insurance company was to make sure that we tied outpatient testing services as a basket of services that was offered to them. And therefore, if they are showing higher compliance or adherence, if you want to use that word, to the outpatient testing services as an incentive that is being offered to them, then therefore, their higher compliance and the modification of their behaviors will be then tied directly as a consequence of their right choices and positive action to lowering, if you will, their claims payment. And they appreciate it. They understand our attempts to make sure that we are taking care of them, and they see a higher value being provided to them by this global insurance company. So Supriya, did I answer your question?
Absolutely. So, I mean, this is a great example of how you can take analytics and put it to action to drive value. This is a tool that was created, that was handed off to call centers. Call centers were proactively able to identify on the fly in real time the customer segment, understand the value of the individual customer, and then they were given targeted scripts to basically take action on them. And so the combination of analytics and the way to reach out to them through an application, a digital application, has truly created value for customers. So like we mentioned during our previous call, and I know we're running out of time, this is based on, and Giri has alluded to this many, many times, this was based on a real case study, and we are excited to be able to tell you more, because now we're getting into the interesting topic of, yes, the analytics is great. We are able to do a lot of different kinds of analytics and interventions, but at the base, right, there is data. And different companies have different data environments. So during the next webinar, we're going to talk about big data, little data, good data or bad data. Different companies are on a different are in different life stages, if you will, with their data journey. What OSG does is we partner with you to figure out where you are in your data journey, and most importantly, how we may be able to leverage your data, what you have today, to drive growth. I know we're at time. I just wanted to see if there was any question on the line.
Hi, Supriya and Giri. Thank you for a stimulating webinar. One question we have is you mentioned about the customer lifetime value, and you provided us with an analytical framework. Can you talk a little bit about how you were able to, you alluded to some of the value propositions you were able to bring to bear on your client. Can you share with us some other aspects that you were able to bring for our clients?
Absolutely, and I'll take that very briefly. Giri gave us an excellent example of retention. The other value-oriented programs that we bring to clients are cross-sell, upsell opportunities. We understand who the customers are, where they are in their life stage and life cycle, and most importantly, based on their purchase propensity, we are able to recommend the right next product and the next best product after that. So cross-sell, upsell is another one, and then finally we are able to understand really the drivers of customer expectations and measure customer experience, because what we have found out and what we have been able to deliver for a global client is an improvement in customer experience, and a 1% improvement in customer experience for this particular client has resulted in more than $100 million worth of incremental value. So there's quite a bit of value that can be achieved through analytics, through digital execution, and through focused operational execution for growth. So with that, I wanted to thank our audience today. I know we ran over by a couple of minutes, so our apologies, but I do appreciate you being here, and we look forward to seeing you during the next webinar.
Thank you.